Hi, welcome to my channel. My name is Venkatesh. I upload content relating to the subject areas of accounting, business and economics. In this particular video, I'm going to be covering part 4, basics of accounting. So in this video, we will be understanding the various types of accounts, starting out with real accounts, which consists of assets. So real accounts speaks about debit is what comes in and credit is what goes out, which we will be getting to see shortly. And then you have nominal accounts, which consists of expenses and revenues. Revenues is also called as income, and nominal accounts speaks about debiting all the expenses and losses and crediting all incomes and gains. And then you have personal account, which is going to speak about capital and liabilities that are there in the business. And the logic of personal accounts is debit the receiver and credit the giver. So now let us understand how do you treat an asset. So generally when you're trying to treat an asset, you debit what comes in. So an example journal entry given here is cash account, which is being debited because cash by nature is an asset to the business, and capital account, which is being credited. But what you need to pay attention to in this particular example is you always debit a real account, which means to say that either the value of the asset whose account is being debited has increased, or the business has acquired more of the same particular asset. And when you credit a real account, the logic is credit is what goes out. Here is an example journal entry. You pay rent, so you say it as rent account debit rupees 500 to cash account rupees 500. So cash here is getting credited because in real account, it implies that either the value of the asset whose account is being credited has decreased, or the business has disposed a part of the asset or the whole of the asset for that particular amount of credit. Next, let us understand how do you treat an expense or a revenue in the business. So you debit when expenses are incurred. In other words, you debit when there is an actual expense taking place in the business. An example journal entry is when you pay rent, which is taken from the previous example of an asset where I said credit is what goes out. Here I'm treating rent as an expense, so rent also gets debited and cash also gets credited. The reason is because a debt in nominal account, so rent is a debt or rent is also an expense in nominal account, signifies that there has been an expense or loss of the amount of the debit, or some income or profit has diminished by the amount of the debit. So cash as an asset has decreased, whereas rent as an expense has been represented in the books of accounts. And then we have to understand the credit logic for revenues, wherein you credit when revenues are gained. And here is an example journal entry for that. Cash account debit because you're gaining the asset here, so you're debiting the cash here. This is one way to understand how asset works. But pay attention to what is being credited to sales account rupees 500. Cash account debit 500 to sales account rupees 500. Sales is an income to the business, so the logic here is a credit in a nominal account implies that there has been an income or a profit of the amount of credit, or some expense or loss has diminished by the amount of the credit. You don't really have to know how this, you do not have to get confused between this logic, because how do you treat an expense? The opposite you're going to do for a revenue, which is why vice versa has been mentioned. You debit when expenses are incurred, but you debit when revenues are lost. Whereas you credit when revenues are gained, but you debit when revenues are lost. So you will understand this logic as we solve more problems in the upcoming videos. But so far, this is how you have to understand the nominal account treatment. So getting to understand the treatment of capital, you credit when capital increases. So here is an example journal entry. Cash account debit rupees 1000 to capital account credit rupees 1000. So the reason why you are crediting capital is because capital is what forms your business. You contribute capital to the business so that you can conduct all your various operations throughout your business activities. But the accounting treatment of capital is debit when capital decreases. So here is an example journal entry for that. Capital account debit rupees 500 to drawings account rupees 500. This particular journal entry we will get to understand in better detail in the upcoming videos. But this is a logic that you must remember. Always credit capital in case of increase and debit in case of decrease. You must firmly remember this logic because as you are a learner, or if you are a teacher, or even if you are just learning this for your passion, or if you're learning this just to understand how accounting works, that is, whenever you have a capital item in the business, you must at any cost, if it is increasing, credit the particular capital account respectively. Coming to treatment of liabilities, another aspect of personal account similar to capital account, you credit when liability increases. So here is an example journal entry to denote the same. Cash account debit rupees 1000 to bank loan account rupees 1000. Now this is a very simple journal entry, but kindly observe. Cash is getting debited because cash is an asset, but bank loan is a liability for the business. Hence, when liability is increasing in the business, you're going to credit it. So bank loan account needs to be credited respectively with cash account because you're gaining cash in the business. The opposite logic also works in the treatment of liability, that is debit when liability decreases. So which means to say when liability is reducing in the business operations or in the books of accounts. So here is an example journal entry for the same. Bank loan account debit rupees 500 to cash account rupees 500. In the previous example, cash account debit rupees 1000 to bank loan rupees 1000. Here you are going to debit bank loan account in case you're making the payment towards the liability. So in case you're going to make payment towards the liability is going to decrease in the business. So here bank loan is the liability which is declining in the business or which is decreasing in the business. So hence you're going to debit bank loan account and credit cash account because when liability is decreasing you debit it, but cash account is an asset which is also decreasing in the business. Hence asset needs to be credited in case of decrease, whereas liability needs to be debited in case of decrease. See, this logic is slowly that you will get to understand as you solve more problems, which I will be doing in the next upcoming videos. So to conclude this short video, so let us try to understand what we have observed in the past few minutes. Assets and expenses, this is the logic that is permanent in whatever accounting transaction that you're going to do. Debit in case of increase and credit in case of decrease. That applies for both assets and expenses. Whereas for revenue, which can be also called as income, capital and liability, you credit in case of increase of these items and you debit in case of decrease of these items in the business. Now you may ask several questions, you may have several queries as to why this logic is being applied for accounting specifically. But before you can delve into the actual details, kindly remember this logic because when I get into the next video where we can understand how assets, expenses, revenue, capital and liability works in the business, you will understand why the treatment of these accounts are as such. And also, I do not want you to panic or worry or even get tensed about these concepts because it may seem really overwhelming in the beginning. It may seem really complicated in the beginning. But as we go on observing in the various videos that I will be uploading, I will ensure that each of these concepts have been covered in detail using various examples. So henceforth in whatever videos that I'm going to be uploading, I'm also going to be solving problems as we speak. So this entire educational content is going to consist of solving a lot of problems that through which we can understand the various accounting concepts and the primary golden accounting practice of debit, credit and the various items that needs to be debited or credited in the books of accounts. If you enjoyed the part 4 of basics of accounting, hit the like button if you enjoyed this video. Comment if you would like to see me cover other topics and do not forget to subscribe to my channel. Thank you so much.